Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Alcana, along with Brianna Valesky, and we had Ashraf Laidi on the line. He's an HFT Forex Strategist joining us today. How you doing today, Ashraf?
Very good. Good to be back.
Yeah, glad to have you back. Well, Janet Yellen's been on the tube here doing her testimony in front of Congress and whatnot. What are you making of
Mm.
her statements and further implications for U.S. interest rate policy?
Yeah, we thought there was nothing new there, but those who were expecting Yellen to be more hawkish than the minutes of the previous week were disappointed. We said there was nothing new because we not only we continue to expect since November that 2015 will not see a rate hike by the Fed, but here are the dynamics. Basically, inflation, as we're going to see tomorrow, CPI in the U.S. is going to be the first negative year-on-year CPI since 2009. It's going to be around minus zero point 0.1. It's going to be very hard for CPI to find its way back towards 1.5 or 1.8% from here until June for the Fed to raise rates. Now, I know a lot of people are saying, listen, how can you keep the same rates as when they were 4 years ago when unemployment was 10%? How can you keep the same rates when payrolls were growing by an average of 1 or 2,000 or minus 5,000? The reality, it's not that. The job market is doing well, but not well enough for inflation to be growing normally. There is still a risk of disinflation. And those who think that it's only, but Ashraf, but inflation is only temporary because oil is going back up. No, 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 no. There is also the risk of importing disinflation from China to the United States. As the Chinese will continue to weaken their currency, disinflation will be imported into the United States, and it's going to be very hard for the bond market and for the currency market to believe that the Fed is going to be able to raise interest rates, and that is what's really driving the continued pullback in the U.S. dollar, primarily against the New Zealand dollar, which is the highest yielding currency, also the British pound, the currency that I like, and also even against the Canadian dollar.
And the Feds are, our Fed and the ECB, they're trying like the Dickens to create inflation and not having much success at it. Looking at the oil market, you
Mm-hmm.
mentioned that people are worried about that, popping right back up. Seems to have found a
Mm.
trading range. Can you give us
Yeah.
your take on the crude oil market?
Yeah, this is the toughest market to figure out. I'll tell you the easy stuff. Yes, we are finding a nice range, but we have not been able. Now, if you look at the WTI, we have not been able to break above that downward channel yet. We've seen some nice recovery. If you look at the weekly chart right now in crude in WTI, the channel from the top of July of last year, the recovery failed the channel. So now we are still down on the week. I think we're still going to try to flirt with the top of the channel around 54, 53. Do I find it? Do I find any catalyst to drive it above 55? Not for now. Not for now. Look, I'm not a specialist in oil, but there's the three major oil figures. There's the API figures, which came in yesterday, which showed a bigger build than expected. There is going to be the EIA figures, which nobody can predict, even the oil guys. That's going to be it's going to be 1 hour from now. And then there is the oil rig, the Baker Hughes oil rig count, which comes on Friday when everybody's thinking about the weekend. That is showing a decline, but it's showing that the rate of the decline is actually declining. So I think that oil is still going to be able to push higher, but not break above the 55 level, which would be defined as a break above the downward channel. But what is important for the currency, guys, is that oil continues to drive it continued to drive the Canadian dollar ups and down, a positive correlation until yesterday. And yesterday, something changed.
And what changed?
I allowed you 1 second to put to put a question there. What changed was that there was a big surprise from the Bank of Canada, the governor of the Bank of Canada, who came in, and everybody was expecting, a lot of people were expecting that the Bank of Canada was going to follow up on January's surprise rate cut with another rate cut in March the 4th. But the Bank of Canada governor, Paulos, came in, and he basically signaled that they could make a pause early next month. They could make a pause. He described that surprising rate cut was an insurance policy, and he disagreed with the use of forward guidance. Basically just after a long drawn testimony by Yellen that we're using forward guidance, he basically said, I don't like to use the guidance, and he did not seem to be to show a signal that there was going to be a rate cut, another rate cut in March. So the market is 50-50, and that's what's driving the Canadian dollar higher across the board. And technicals, if you look at a chart in dollar CAD, we could be retesting 123.60, 123.50. There is a flag there that is about to be broken down. And so that's why the Canadian is able to rally against most of the currencies, even though oil struggled yesterday. However, if the EIA today, the EIA figures, the inventory data, is going to show, a lower than expected build or a bigger than expected decline in inventories, we could see dollar CAD really extending the sell-off towards 123.50, 123.30.
And moving away from inflation targeting was also mentioned. What's your take on that?
Moving away from inflation targeting, yes, this is what Paulos said. He said that basically the Bank of Canada said that they were going to revise their inflation target. I think what that means, and that's another reason which drove the CAD higher, which means that probably they may move towards a slightly lower inflation target. That in English meaning that they are going to remain they're going to remain less hawkish than expected. So that's what's really that's what's really causing a two-way market. And here is what Paulo said. Everybody said, listen, but you need to cut rates further. Didn't you say that it's all about oil and oil is weighing on the economy? He said, no. He said, listen, I'm not here to target the currency. You have to know that the Canadians were one of the most vocal critics of Chinese currency policy, and they continue to do so. So they don't want to be seen as targeting the currency. And when they told him, but what about the rebound in the Canadian dollar? He said, well, we need a two-way market. So all of this is quite interesting. And actually, since you brought up CPI, tomorrow at 8:30 New York time, 1:30 GMT, we're going to see at the same time the release of the CPI in the U.S. and the release of the CPI in Canada. And that interplay is going to further boost the dollar CAD. Sorry, not boost it, but I think it could weigh on dollar CAD.
Okay, I'm just taking a look at the ETF here, the Canadian dollar, the FXC, and it's showing some little signs of a bottom here. So I guess looking at that chart, it came down very, very hard. This is basis the ETF, the $88 level, but we'll see. We'll see if we found a bottom here. One of our guests in the chat room would like your thoughts on the Treasury market.
Oh, boy. Yeah, treasuries. Well, if you look at the 10-year yield, we still think that the medium term, when you're looking at the medium to long term, weekly to monthly chart, we still think that the 10-year yield is going to continue to go lower. Okay, this is where we have been holding this stance since summer of last year when many people were still expecting yields to go up. We're expecting them to go down. However, the short term right now, here's the thing: the bond market is expecting is being actually less hawkish than what the Fed is. Okay, so one of the other reasons that we do not expect that the Fed to be raising rates was that even though yields were pushing higher and now they came back down. If the bond market changes its mind and decides to agree with the Federal Reserve forecast for a Fed rate hike probably this summer, then bond yields will have to go up so fast that they will spook the Fed. We need to know, everybody needs to know, and I think a lot of people need to know this who are not in the market. The Federal Reserve cannot have the 10-year yield push up. It cannot have the cost of its credit card bill go up simple. Now, technically, look at the 10-year yield, look at the weekly chart. We've seen multiple failures, 1, 2, 3, 4, 5, 6, 7, 7 failures of the 200-week moving average in the 10-year yield. The 200-week moving average kept on going down, and we were seeing lower highs on the weekly chart in the 10-year yield. Even though we jumped for 3 consecutive weeks, this week we're coming back down. It's going to be very hard for 10-year yield to go above 2.23, 2.24. And so that's basically that. The monthly chart looks like we are going to have the first month after 1, 2, 3, 4 declining months. We had 4 declining months in the 10-year yield. February, we're going to see the first month of the first rallying month, but we're not going to go above 2.25 or 2.26%, and we're going to slowly find our way back down towards 1 point, I would say 1.56, 1.55.
Okay. Also, just we don't talk a lot about stocks with you here, but I'm sure you keep an eye on them. And big story is Nasdaq 5,000, and how when last time the markets got up to this level, it was trading at 100 times earnings. Now it's trading 21. That sounds like a real bullish scenario to me.
It sounds very bullish. I was able to escape the earnings season quite well, despite we've seen we've seen a good average as far as beating earnings, as far as beating revenues. I'm not an equity specialist, so I'm going to leave that for the many experts on your website. But basically, it was able to pass that test. But then again, you can tell me that's a result of managing expectations and putting expectations down. But the stock market, I still think that we're going to have a very difficult year this year. And here is what we need to learn from the past, ladies and gentlemen, everybody who is listening. For the last 4 years, every time the month of June signaled a possible turnaround in Fed policy, it was always preceded by a very bad April and May. You may tell me, but Ashraf, we know this already. It's called the go away, sell in May and go away. We did not have it last year, but here is what happened. Since 2010 or since 2010, April, May, there was always a pop because June was the end of either a QE2 or a QE3. So what we're going to have this June, we're also going to have an inflection point in Fed policy. And once the market knows or expects an inflection point in Fed policy, it will have a top or a top in April and probably a bad May and a bad early June. So all is fine and dandy right now. The chart is looking well, 21.15. We could go to 21.80. But as we approach the sell in May and go away notion could become even more emphasized ahead of an inflection point or expectation of inflection point in Fed policy.
Okay. Also, just take a look at the ETF on the dollar here. Obviously, Fed policy. Big forecast of what the dollar is going to do. It's had a very, very nice run up here, having a period of consolidation here.
Yep.
Consolidation considered this to continue the strong uptrend, or have we found a short-term top in the dollar?
Yeah, I think it's a short-term top. Is this the beginning of the end of this rally in the U.S. dollar? No, I find it hard to believe that. Even if the Federal Reserve, let's say, if Yellen decides to keep the patient guidance next month, which is a very important meeting, or if she takes it off and she readies expectations for a June hike, and let's say come the next meeting the next meeting will probably be in April, not in May, and let's say she sounds off dovish, the dollar could pull back, but I don't think it could break. What does it break? It's unlikely to break its long-term rally. That means that we could see 115, 115.50 in the euro. We could probably see 159, 158 in the sterling, but we're probably unlikely to see anything higher. So that's what's important. Yes, there is expectations. Even if expectations of a Fed hike are going to be reduced, The dollar could see, we could see. So if we're looking at the dollar index right now, with the DXY right now, it's trading around 94.35. We could probably pull back towards 93.05, 93, maybe 92.80, and that would be the point of the correction.
Okay, final thoughts here on the chance of a Chinese devaluation and thoughts on the
Yeah.
yuan.
Well, this is a point that we've been holding here. Let me see here my chart for the
Okay.
reference rates for China. And and this is something we've been saying basically is that the U.S. dollar continues to go higher against the Chinese yuan as far as not the reference rate, the one that is set by the central bank, but the offshore rate, the one that is allowed to vary 2% up or 2% down relative to the reference rate. And the U.S. dollar is pushing higher, the yuan is pushing down. So basically, the offshore rate is right now at 6.25. U.S. dollar is buying 6.26 or 6.26 Chinese yuan. That is basically an increase of around 4% from the lows of January of last year. And we expect that we could see another 4% for this year. Well, probably another 3.5%, and we could go all the way to 6.45 or 6.5 in the U.S. dollar. This move could be managed a little, managed more and more, managed, not in a drastic way. We could see further increases. The Chinese are sending weak signals day and after day. Yesterday's PMI was an exception. And I think that will be one of the reasons that the Chinese don't want to be the only quote unquote strong economy in town. They cannot afford to see their currency remaining the only one that is higher. And I think as they lead to further easing monetary policy, I think we could see further weakness in the Chinese yuan, managed very smartly, very intelligently, very discreetly when everybody is busy with everything else, and that will complicate the task of seeing inflation going back above 1.7, 1.5 in the U.S.
Okay, final thoughts for our listeners here. Second day of testimony from Janet Yellen. Market
Mm,
trading up at all-time highs here.
mm.
Everything good earnings season. Everything's rosy. Is
Everything.
anything to change that outlook here in the short term?
The speech is going to be the same, and the joke is that once Yellen takes the newspaper and realized that she was more hawkish, she was more dovish than expected, she could probably change her tune in the Q&A. I don't think that could be the case. I think we could see some technical, not pullback but push up in the U.S. dollar here. But I think that in the medium term we could still see a heavier U.S. dollar. Equities, I think they still probably going to continue to like the Europe play, and to a lesser extent the U.S.
Okay, Ashraf Laidi. He's a HFT Forex Strategist joining us here on Benzinga's pre-market prep. Thank you. Love your input on the markets and the U.S.
My pleasure,
dollar,
guys.
and looking forward to speaking to you again soon.
Same here, guys. Thank you.
All right, a couple issues to take a look at here. Sam Adams was getting annihilated here in the pre-market. Let's see what it is continuing here. Aren't people drinking this beer anymore? I can't remember. It had some earnings that were okay, but boy, oh boy, we have lost 46 points, 15%. We are trading down through the pre-market low. Let's see if we can find a potential area of support here. Boom, just annihilating the 270 level. I guess if you want to stick your neck out here, 258 even. That was your low on December 2nd. We are currently trading at 261.50 with a low at 258.46. before we started the last interview, Crocs, and I don't know if there was any news out on that one, but the maker of shoes with holes in them, not doing well. I think it was a big company was getting private in them, and I believe that was like around 16 bucks here. I guess we're just trying to find a support level just above 10 here.
You know, Joel, craft beer is the all the rage right now. That might be why big beer companies are suffering. You want to take a look at a couple more issues before we jump into things? I'm a little curious to see
Yeah,
HPQ.
yeah. Let's take a
Yeah.
look at that here in the final minute. HPQ. Let's see how it's trading in relation to the pre-market. Had a pretty good rip down and not
Oof.
finding any support here as of yet. We've taken out the pre-market low at 35.50. We have traded down to 34.96. I guess the only thing you can get in there is throw in the whole number theory here at 35. You did have a few other lows at 35.04 and just under 35, 34.80. So potential area of support there, 35. Trying to come back a little bit.
Did we talk about DreamWorks earlier? DWA?
DWA. Nope, that is one that we missed here.
They did report last night, yeah.
Okay, that's one we don't talk about DreamWorks much, but it is getting a little bit of a pop here after a much lower open. Actually, opened near the lows for the session, 1920 open, 1916 low, and got a nice pop going. I got up to 2044. Just keep an eye on 2058. That was a low from yesterday. That will fill the gap in the trading. Well, it's 9:43, Brianna. It's time to preview Thursday's show.
You bet. Well, we'll have JC Peretz on tomorrow at 8:35. He is the founder of Eagle Bay Capital, and then we'll be joined by our very own Sheldon McIntyre. He's the founder of 360 Virtual Advisor at 9 a.m. And then Greg Harmon will return to the show. He's the CIO and partner at Presidium Capital, as well as the founder of Dragonfly Capital, and that's at 9:20. Just a final reminder: our show is brought to you by our friends at Nadex, where you can find protection from market spikes and opportunities in flat markets using binary options. Open an account today with no fees and only $100 as your minimum deposit. Tell them your friends at Benzinga sent you. If you miss any part of today's show, you can listen to the whole thing again on our podcast. Find us on iTunes, SoundCloud, and Stitcher by searching hashtag free market. And please always remember that all of the information, content, and material in our program is for informational purposes only. Investing in stocks, options, and futures is risky and not suitable for all investors. Please consult your own independent financial advisor before making any investment decisions. And don't forget, this Friday, guys, all about crude oil is our next special segment where you can have your questions answered by Dennis Gartman, Ron Insana, Doug Cass, and many more experts in the field. So don't forget to tune into that. That is this Friday, February 27th. All right, Joel, I'm done with my plug. You can wrap it up for our traders now.
Okay, S&P is trading near the lows of the session, down 375. Haven't been able to reach the pre-market high 14 and a quarter. That's buffeted by 1375. That's the all-time high close. Slow sell-off here in the morning. No major support till you get to yesterday's low of 2002.75. Have a great trading day. We'll be back with you tomorrow morning.